Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to Katie Potts of Herald Investment Management, one of the UK's smartest investors and an expert on all things technology, media and communication. So welcome, Katie.
Thank you very much.
Now, I was having a quick look through the Herald portfolio and the sort of the returns, and it seems as though the funds have consistently beaten all the major, certainly beaten my portfolio, certainly beaten all the major UK indices, quite handsomely, in fact. What's been the sort of secret formula behind the long-term success of the funds?
Well, I'm an evangelist for small companies. We dubbed the FTSE 100 the losers index. But if you go back to the NUMIS indices over 50 years, the small cap indices have outperformed. And then within it, the sort of sectors we focus on are quite young. It's very hard to start a small bank. This environment is about the first time there have been new banks because of the challenger banks, but you still need to have a lot of capital. Whereas you can start tech companies and media companies with much lesser outside capital. And one of the fun things about it is we've invested in so many entrepreneurs over the years who've needed development capital. And I think in the UK, there's been an environment where there's been VCT and EIS has helped seed businesses, but often follow-on capital has come through AIM.
But what do you look for, Katie?
For us, AIM has been profitable.
What do you look for specifically in a company, Katie? Is it sort of like IPR knowledge?
I'll explain that. When I started in 1994, we said at least 50%, or at least 75% would be UK and Europe, and we had to have at least 50%. You're probably not old enough, but at that time you had to have at least 50% in the UK to qualify for your PEP.
Oh, okay.
And then you had to have at least 50% for ISA, and then that was abolished. And in 2000 we went down to 38% in the UK, and I thought, well, we'd never go above that again, and the rest of the world was much more interesting. And actually, to my surprise, we found it easier, except in the recent past, to make money in the UK. And of the returns, we've made just over 1.5 billion of total returns since the fund was launched, and we've raised 95 million of outside capital. But within that, we've made over $1 billion in the UK. Right. And the $60 million question is why? Because intuitively, there are so many more big tech companies in the States. Hasn't that been an easier place to make money? Well, actually, in small companies, it hasn't. And I think the reason has been there have been lots of people who've made lots of money as venture capitalists in the States, but then they floated companies very expensively and had share-based payments that are viciously dilutive. And particularly recently, it's quite normal in the States for 5% dilution from share options, whereas in the UK, touchwood valuations have been more reasonable, and there hasn't been the dilution. But the notable exception has been the last 2 years, when we've done better in all the overseas markets than we have in the UK.
But I mean, presumably the portfolio looks as though it holds a lot of its small caps for a long period, and then really sort of seeds it and lets those acorns grow and become sort of huge, it's oak trees, and you get a multiple expansion as well as you get that growth in just the earnings.
Yeah, absolutely. And we haven't been shy of investing in loss-making businesses, and in fact, it's not just by accident, but we've fairly consistently had about 17% of the portfolio in loss-making companies. And I think people find it very challenging to value businesses before they reach profitability. Mature companies you can value on a yield or a PE, but immature companies, those criteria don't work very well. And we've never been shy at investing in loss-making businesses. And as you say, we've made the most money out of buying a loss-making business, watch it through to profitability, and then a re-rating. But one thing that I do always try and think through on a valuation is, well, what's it got to do to be on a P of 10?
That isn't a very stretching multiple.
How much have sales got to grow? And how big is the potential market? What percentage of the market do they need to get? And what's the gross margin that they make on an incremental pound of sales? And as I say, I don't mind buying loss makers. I don't mind buying very high PEs, as long as I can see that at some stage it can grow to being on a P of 10, even if it's 5 years away.
Yeah. A path to profitability.
To know that it's got
a path to profitability,
and that the market is big enough, is scalable enough, and they've got enough pricing power to make margins out of the growth in revenues.
Yeah, some IPR and high unit economics and that kind of stuff, which is gives it that scalability. Just on, well, how do you actually define technology nowadays? That's a real tough one, because most companies now have digitized and it's smart everything. Even my flipping fridge is smart. You get a lot of companies claim to be technology, like WeWork did a couple of years ago, which was a real estate business claiming to be a like a fast moving sort of software business. How do you define technology?
Well, it's slightly grey, isn't it? But we have never thought an online shop is technology.
Yeah.
I mean, if it comes to that, you could call fund management a call center.
There's plenty of big IPOs in the US at the moment.
We have made the exception of Amazon, where we have invested in Amazon on the basis that they were innovative over the Kindle, and they were incredibly innovative. You know how they started Amazon Web Services, because they realized all the data they were collecting from an online bookshop. They didn't want to pay expensive fees to third-party database providers, so they developed their own. And they gradually built more and more technology themselves, and they thought, well, why don't we supply this to other people as well? And that's how Amazon Web Services came into being. But so
that must have been a home run for you guys, the Amazon, because I remember back in 2003 looking at Amazon and going, is it going to go bust or not? And it was $13, and I think it's past 3,000 today.
Yeah. No, I have enormous respect for Jeff Bezos, and we were lucky enough to be in Apple when it was virtually a small company. It was 7 billion market cap in November 2003 when I went to see them. And they'd come up with iTunes and explained they weren't trying to make monthly revenues, but they were trying to shift product. And obviously that the next thing they seeded was the iPhone. One of the things that I get asked a lot these days is that we had the tech bubble in 2000, and that's when we went below 40%, below 50%, below 40% even in the UK, because there were sort of huge valuations that didn't make sense. I couldn't see how you could get to a P of 10 in quickly enough to make sense of valuations. And people are asking me, are there parallels now? Because there has been a re-rating. Obviously in the last year or two, and I absolutely don't think there's the bubble that there was in 2000. That said, I wish the valuations were more as they were in 2008, 2009, when there were single figure PEs today, let alone in 5 years' time.
You must be finding it easier to sell rather than buy at the moment. Or more tempting to sell than buy.
Yes. But what's interesting is there are odd stocks that have shot up. It's not the widespread re-rating that there was in 2000 when everything went up indiscriminately. It is now more discriminate, and we saw a good run in things like unified communication stocks that surged on the back of work from home, and there's been a bit of excitement in computer gaming companies because people are using them at home, and then before the year end, there was a bit of a surge in security companies when the Russians hacked.
Yeah, cyber security.
Yes.
Yeah.
Yeah, when the Russians hacked by putting malicious software in an upgrade from
solar winds.
Solar winds.
Yeah. So what about just on the?
But you might be interested to know that in the last year, just in 2020, the UK portfolio, we have the benefit of uploading our portfolio to Bloomberg, and they spew out the data on Bloomberg forecasts.
Yeah.
And on Bloomberg forecasts, the UK portfolio was re-rated by 20% last year.
Right.
And I think the portfolio went up by over 30%, which shows there was profits growth. But the European portfolio was re-rated by 40% and North America by 60%. So although the UK has underperformed, it hasn't underperformed in profits growth. It's only underperformed because it hasn't re-rated as much, which I think is quite an interesting dynamic. And the $60 million question is, does that re-rating hold? Does it continue?
Just on that one, on that question then, Katie, I mean, when we come to the reopening trade, I mean, there's no doubt about it, medicine and IT have got the world through this pandemic in terms of a lot of the heavy lifting with regards to sort of like, communications and working and stuff. In fact, even my next door neighbour, unfortunately, she's got a Zoom funeral today. It just shows you how important sort of the communications is. And as you say, the $64 million question is what's going to happen after we get mass vaccinations, and how do you see that with some of the long-term trends that will be sustainable, have been accelerated in technology, and those which might sort of like struggle? For instance, am I going to buy another 3 PCs at home for my home office? What's your thought?
I think there's no doubt there's been some acceleration in demand, and it's really noticeable from the companies. I had sessions with 30 US companies last week at one of the US virtual conferences, and very much one of the themes is there's a tightness in semiconductor capacity.
The car manufacturers can't get enough, can they? They've had to basically halt some of their production.
Yeah, it's very unusual. It's the old-fashioned ASIC semiconductors capacity is tight. And the issue is, how much is that because there's been restocking
yes,
and an acceleration of demand, and how quickly can supply be expanded? But nevertheless, it is extraordinary to be in a world where you've got capacity constraints and synonymous with boom conditions and horrible declines in GDP. But as you say, tech has been filling the vacuum. But I think there will be some stocks where there was accelerated demand. But one of the big drivers that continues to, well, there are 2 big drivers that continue to excite me. One is the whole data center.
Yes.
Amazon Web Services, Azure, our focus is really on small companies. You think, well, aren't they big companies? What's that got to do with small companies? And the answer is it's got everything to do with small companies, because it's dramatically reduced the capital costs for startups and for small businesses. When I started, little diddly squat software companies had to raise millions to buy a mainframe or an AS400 and buy a storage array, and now you can rent processing power, you can rent storage. The internet is available domestically, let alone you don't have to lease a line in the way you used to. And so the barriers to entry are so much lower. So I think it's a stimulant to the entrepreneurial end of the economy.
Yeah,
you can start a business in your back bedroom now, and that's why there's a continual flow of companies that we have the opportunity to see and invest in. And the second big exciting driver, I think, is renewable energy, where wind and solar has become so much cheaper than it was. The logjam is storing it efficiently, and you can see the race is on.
Yes.
Hydrogen. How do you store it?
Yes.
Yeah. Well, hydrogen or better battery technology. There are multiple routes, but the race is on.
Yeah.
Yeah.
But when do you get to the point where you have?
But that's the knock-on effect of that is, it's been a big problem for us and emerging companies, the balance of payments of having to import oil. It's a one-off capital cost, so that you don't have the running cost to import, and it has amazing potential to accelerate growth in emerging markets and give them the capacity to want technology and have technology. They've already got phones, but you can see it will be rolling out to more products and applications.
And when do you get to the point where you think that sort of like it's worth sort of, and again, this is the pun with semiconductors, taking some chips off the table just on purely valuation grounds? Because a lot of these renewable energy stocks, frankly, have gone to the moon. I mean, they're sort of like, 5, 10, 15 times sales in 2030.
Well, they are reaching the point where, how many years will it take to get them onto a P of 10?
Or just even get some sales.
Exactly. No, I mean they're uncomfortably high, and we've taken some profits in one or two of these things that have run very hard. But equally, there is a huge driver behind ESG investing.
Yes.
Professional investors are having to think more about it and justify it, and there are a limited number of stocks to invest in.
And has ESG created a bit of a bubble here at all, Katie? I mean, it looks to me it's added a bit of sort of like kerosene to the fire.
Yes, I mean, if I make the analogy with the internet bubble of 2000, that put everything on bonkers valuations. This time around, the bubble is in the green stocks, isn't it?
Yeah, and also, so I think some of the cloud. I mean, you've got to be a pretty brave investor to stick some new money into Snowflake, which is on 80 times next year's sales. I mean, just seems okay. They may have fantastic technology, but that's given they won't make any. I think that 10 times PE multiple might be 2050 for you, Katie, if you put some money in that one.
Yeah.
Okay.
And put it another way.
Yeah.
What were the exciting software stocks in 2000?
The exciting software.
I remember going to a conference in 2000, and the keynote speaker was Tom Siebel. Siebel was the hot stock for customer relationship management. And where is it today?
Yeah.
An irrelevantly small subsidiary in Oracle.
Yeah.
And Salesforce has superseded it.
Yeah.
You've got to be very careful about thinking companies will go on forever.
Yeah. Exactly. And the big risk, the big risk as well, I guess, Katie, is that as the yield curve steepens and you get sort of like higher US treasuries, the sort of like the discounted, if you ever try and discount a cash flow out of these things, the long duration assets become less attractive because you're only getting returns after 20 years. Possibly? No?
Yeah. But I agree, but and eventually interest rates will go up, but there must be huge political pressure everywhere not to put them up this year.
Yeah, I don't think they'll put it. I think it's just all it is inflation, isn't it? It's keeping that sort of like the real return on bonds becomes even if the long end doesn't increase, then you get basically, if you get higher inflation, you're going to get more negative long-term bond yields. And I think that's where the market's gone, is such that expectations for inflation have risen, and therefore it's steepened the duration side of the yield curve. But okay, what about technology in terms of some of the, because you talked about it's obviously a winner takes all type of market. There's obviously a few stocks which go through tough periods. How can you distinguish about whether to keep them or not? I mean, something like Intel, I did notice it's in the portfolio, for instance. It's got now just appointed a brilliant sort of CEO, which has sort of like helped the market, but it did strategically stumble on its 10 nanometer wafers and lost that sort of time advantage to AMD.
The interesting thing is the shortage of of leading edge semiconductor companies outside Asia now. And I do think the China US tensions will run and run, even though Trump is history. I do think America has been slightly frightened to realize that they are behind the curve. And yes, TSMC is and Samsung have beaten them at leading edge geometries, and Intel is straggling. It was quite expensive manufacturing to them.
Yeah.
But why I still own them is I think there's enormous political motivation for the US to have capacity at home. You know, you see what the tensions are with Hong Kong. There are tensions between China and Taiwan. It's pretty scary to think how dependent we all are on chips out of Taiwan, and the Americans are forcing them to build fabs in the States. But if you think about it, you know, AMD chips, Qualcomm chips, Apple, there's a vast range of the supply chain that's dependent on semiconductors coming out of Taiwan. And I'm sure it'll be the US government will do all they can to ensure they have a domestic owned business.
But will that help? That will help Intel. I mean, the thing is such that if you get just broader, if you've got a company that strategically stumbles, you know, and has been going south for some time, even though it looks cheap, is it a value trap, or is it still a sort of like it can be a sort of like a company that can turn itself around?
I mean, it's interesting how AMD has become really competitive because they've outsourced manufacturing to TSMC. And TSMC, I think it's frightened the States that they used to think leading edge technology was defense in the States. And thanks to Apple, TSMC have now got the leading edge geometries, the leading edge processing speeds. And of course, Apple is now using Imaginations technology to process for processors in their own laptops. So that's another competing factor. But
so how do you, just big picture then. So like,
obviously Micron on the memory side has got some capacity in the States.
So just coming back to sort of the original question in terms of how do you see when the reopening trade with technology, given the sort of basically outperformance compared to sort of the traditional companies, do you see when the economy gets going, obviously you're going to get a huge increase in earnings on the beaten up stuff, you know, as people get back to as more normality. And is that going to act as a bit of a headwind for technology, given that you could see technology do well in terms of its earnings, but have difficult comps, and obviously a lot of the price has been brought forward?
I think there'll be a subset of the sector that has difficult comps, but it's very much a subsector. And I mean, I just quantify it. Our UK portfolio at the end of 2013 was 16.9. At the end of 2018, it was 15.9. So broadly, valuations went sideways for, 1, 2, 3, 4, 5, 6 years?
Yeah.
And they're now on a P of 26 times. So that's the degree of how much things have become more expensive.
Yeah.
On the other hand, money has become much cheaper.
Yes, exactly.
Interest rates have fallen by even more than that. So against that background, that doesn't seem that expensive. And at least with technology where there is growth, you can still get, you know, if there is a market derating, then it's only a couple of years for it to catch up again.
Yeah. What sort of risks do you see to the sort of technology trade?
You can argue that there was, the era of interest rates coming down and the market being re-rated, it made non-growth stocks look like growth.
But what do you see as the sort of the key?
Has some fairly commodity boring stocks.
Yeah, what do you see as the sort of key risks on the technology front, on the investing going forward? Is it going to be sort of like, you know, the big caps where you have increased regulation with Biden coming in and the Democrats? Is it going to be sort of digitization? Is it going to be calls to sort of break some of these guys up who have got super monopoly type of characteristics, or how do you see it?
Yeah, and political tensions in Asia.
Yes, with China in particular.
It was really obvious that in February there were supply chain issues all over the place. And it's been remarkably lucky that China has controlled and Asia's controlled coronavirus so much better than the West, because none of the tech sector wouldn't have been anything like as robust last year if they hadn't had the hardware supplies coming through okay from China.
Yeah.
And Taiwan. But there has to be a risk of turbulence and the dependency on products from Asia. But I guess the biggest risk to valuations is, as you say, interest rates rising, and at least on the whole, tech companies don't have leverage.
Yeah, that's true. Absolutely, yeah. Other than it would just be a valuation compression, won't it?
Yeah.
Yeah.
Whereas other sectors, it will be worse than that, because you buy cars on tick, you buy houses on tick.
Yeah.
Property companies.
Yeah.
So there's lots of sectors that will be hit worse.
Yeah. Well, you mentioned there wasn't that many similarities between sort of 2020 and 2000 and 2020 when the dot-com bubble. But one thing which does seem similar in certain areas today is the amount of capital flooding into technology, particularly software and, as you say, renewables. And that may be private as well as public markets. And you've obviously got the Robin Hood sort of like momentum trade on top. It seems to me, in terms of what seems to me as a similarity, is a sort of destruction of capital discipline when it comes to allocating new money. Because a lot of people appear to be bombing for money into some areas when, frankly, the long-term returns are very unlikely to meet what the money was put into, in basic. So you do have a sort of like almost like a burning of capital allocation of money on the entrance, which could unfortunately unwind and make a lot of people disappointment further down, which is exactly what happened with the dot-com bust. You don't think that
capital is worthless at the moment, isn't it? I mean, the fact you've got zero bonds.
If I would try and look after it as much as I could.
And capital's virtually free, and it moves around the world as well.
Yeah.
But I beg the question: the most successful investment of the century, practically, is Apple. How much capital went into developing the iPhone?
Yeah, I don't know. You're closer to it than I.
They bought a load of commodity parts developed by other people.
Yeah.
And had the innovation of the app where you could touch. It suddenly made the internet work on a phone by having an app that you could just touch.
Yeah.
And in a way, that's the fun thing about technology is it's not, and why I get frustrated when economists go on about the lack of capital being invested.
Not in technology.
We're in a knowledge-based world, and the return is on knowledge, not on capital.
Yes.
And you could build, it's not rational to build a factory in the UK, fill it with machines, and think you'll get a return. Because land's expensive, labour's expensive. We want to earn more than that. What you want to invest in is ideas, technology, and branding. And then why the likes of Alphabet and Facebook have been so successful is the barrier to entry is the network effect.
Yes, agreed.
That it's not the technology per se, it's the networked effect. Or you could say the same with Microsoft.
Yes.
It's the networked effect that everybody knows how to open a Word document, so everybody uses a Word document or an Excel spreadsheet. So the network effect is a powerful barrier to entry. And the fact in the software sector, a marginal sale, extra sale has marginal extra cost. So there is a case for winner takes all.
You're selling air, aren't you, with software?
Yes, yes. And even in semiconductors, it's hugely expensive to tape out a new semiconductor. It can cost sort of several million to design a new semiconductor. That's an application-specific one.
Yeah.
But it means there's huge advantage on cost for the people who've got the scale to write off that tape out.
Yeah.
So to me, that's one of the appeals of the sector, is that there are a number of reasons in several different directions why tech stocks can make supernormal margins.
I agree. Yeah. I mean, it's scalable. It's high unit economics. It's high barriers to entry. And if you get a sort of like,
and then patents is another area.
Yeah. I mean, I did notice the portfolio, having been called a TMT portfolio, you don't own that many traditional media companies or telcos like, I don't know, Verizon and BT and stuff, because they're really pipe work rather than actually real IPR.
No, it's very much new media rather than old.
Yeah. Good. Okay. Well, actually, I've been remiss to end the interview without actually asking your view on Bitcoin, because that's sort of like being a momentum. Is this a real asset, or is it a tulip? I don't know.
It's been a hot topic. I think the younger generation are excited by it. I did have a ransomware attack a couple of years ago. I'm glad to say we were backed up, but I did notice that I was asked to pay the ransom in Bitcoin.
Yes.
And as somebody who, has to pay tax, and it frightens me that Bitcoin is being used by gamblers
and organised criminals.
And organised criminals. And there has to be huge risks that they have to somehow make it illegal.
Yeah. And
they can make it illegal by making it very difficult to interrelate with the legal financings.
Yeah. I guess you're going to struggle to find a 10 times PE multiple on Bitcoin at some point. It's never going to earn you anything, because it doesn't pay any interest, certainly Bitcoin. I'm guessing anyway, on the sort of capital side. Just before we finally then, so we've obviously got cloud and renewables and scalables. Is there anything specifically you would say investors should anything additional that investors should cast their eye over in terms of potential future sort of investments at all? Maybe in the UK, US, or anything? Just sectors, or something which is of interest?
Well, I mean, look at where the disruptors are. One is cheap energy. I don't suggest chasing the valuations on some of the energy things directly, but there will be knock-on consequences of having very cheap energy and cheap capital available.
Yeah.
Perhaps we'll be having factory farms in the UK where we have renewable energy making completely
so the
artificial environments to grow vegetables.
Yeah, the picks and shovels guys as well, I guess, mate, who are further down the food chain, who haven't actually had the re-rating.
And then you've got the 5G bringing edge computing, more and more processing near the edge.
Of things and stuff.
A very crude analogy is I'm hiding at my mother's house, and my grandparents lived here before electricity came. But when it did, a copper cable was put in, and there was an electric light on the end of it, and not much else. And nobody conceived that grandchildren would be having computers and Zoom calls.
Yeah.
But it's the same old copper pipe, and I'm sure the internet will be the same. is that we haven't yet thought of all the applications that'll be useful. We're still just about getting to the stage of the rollout happening.
Yes.
It's still got to be upgraded in places, but there'll be all sorts of applications once we're connected that will go on getting rolled out.
Brilliant. Well, okay. I agree, because certainly it's an area that I'm investing in and interested in, because I think one thing the pandemic has told us is certainly that the technology, software, conferencing, anything to do with sort of like bringing people together and allowing them to work from anywhere is a permanent change. And you've had that with Unilever saying this week that a lot of its workforce are not going to go back full time to the office, and many other people have sort of like ditching sort of property, etc. So there's going to be long-term growth in these sectors. So I'm with you, Katie, and a big thanks for the interview. And I'll very much look forward in touching base again going forward.
Okay, thank you.